Do you have a really low interest rate on your house, 2.75, 3%, and you're not selling your house because you're like, man, why would I sell it? I have this great interest rate. But wouldn't you love to be able to move that to another house? Yeah, everybody would. Well, the government's trying to figure that out as they're looking into what's called a portable loan. And most people are like, what the crap is that? And I get it. So today we're going to break it down. What is it? Is it possible? What does it look like? What are all the details? We're going to break that down for you today. What's up, everybody? Welcome back to Real Talk Real Estate. I'm your host, Mark Cann, local realtor here in the Phoenix area with my home group real estate and owner of the Benchmark Real Estate team. As always, guys, podcast format, here to be real with you, give you information so that way you can make the best decision possible, not trying to convince you of anything. So today we're going to talk about something fun that most people haven't heard of, and that is portable mortgages. And that is something that the current administration talked about. They said the 50-year mortgage, everybody talked about that. I did a video on that last week. But then they also mentioned they're looking into portable mortgages. And most people kind of missed it. And I was like, oh, interesting. So I started doing some research. So we're going to talk about that today. What does that look like? Is it possible? I'm going to give pros and cons. So I'll start out with pros and cons. Oh, I'll explain what it is. Then I'll talk about pros and cons, and I'll kind of give you the take on it of how it could work if it could. So, portable mortgage. It's pretty much, let's say you bought a house in 2020, have a mortgage interest rate of 2.75%, and you're like, I don't want to sell my house because I want to keep that. Yeah, I get it. Totally understand. I would want to keep it too. And so what they're proposing, a portable mortgage, it exists today. It's not very common because not all loans, and this is one of the cons I'll get to, but not all loans can be portable. So that's where they're looking to it. Can they change it? Can they make, more loans portable or assumable? So what it is let's say you have your mortgage on this house. It's taking that mortgage with the rate and its rate, its balance, all of that to a new house. That way you don't have to get rid of it. Sounds super attractive. I mean, I thought that sounded really cool. Now, obviously, there's caveats for everything, especially when you're getting into this kind of stuff with that kind of money. So let's talk about pros and cons. We'll talk about pros and cons of it real quick. So obviously, the first biggest pro is you keep your interest rate. So if you have a really low interest rate, 2.75%, 3%, yeah, you want to keep that. Totally understand that. Other things is you could avoid penalties. You could avoid some other fees for lenders and such that you wouldn't be able to, or you wouldn't have to pay those things. Can be a smoother process in instances where it does happen. But it's protecting you from rising rates, right? Being able to keep your interest rate. Now, the cons of it is you still have to requalify. So for the loan that you had already qualified for, if let's say you lost your job or something, you still have to requalify. So that could be a con. There's limited time windows with it, typically. The other thing too is, again, like I said earlier, not all mortgages are portable. So that's where it gets kind of tricky because lenders do all that stuff differently. Again, if you want more information about this, call your local lender. But the biggest con, I think, is with more expensive homes. This is where it gets really tricky. And this is one of the problems we'll have here in Phoenix is, let's say you bought a house for $275,000 and you put the minimum down, and that was, let's say 2019, 2018, whatever. Now it's worth $450,000. So you have a mortgage balance of like, let's say $240,000, something like that. Okay. You have that balance. Let's say you want to go buy another house. Now, typically when most people want to go buy another house, they want a more expensive house. So you would be able to get your equity. So you'd be able to sell the home. You wouldn't pay off the mortgage. It would just transfer to a new property. And this is where it can get very tricky because do you need to do that before do you need to sell your house first? Do you need to buy another house first? Like, that's where all this stuff gets murky, and there's not necessarily answers for it right now because they haven't come out with details. They said they're just looking into it. But this is where some of the problems run into is like, okay, let's say you have that $200,000 in equity, but you want to go buy a $700,000 house. Okay. Like, you have that $200,000 in equity you could put down. You have that other mortgage, but now you're going to have to get another loan for the rest of the amount. So now you're going to have two mortgages. It might be cheaper overall to do it that way. But again, it's going to be really murky. It's really going to be complicated. So I don't know if they're going to be able to figure this out. Be honest. Like, I know a lot of people would love to be able to take their mortgage with them. I just don't know that makes sense because of how much equity growth people have had. Now you have all the equity growth, you can put that money down, so you probably wouldn't have to get that big of a mortgage. So like in that situation I gave, 275, now it's worth 450. Let's say it's worth 475 for round number's sake. Let's say you have $200,000 in equity. Okay, $200,000 in equity, you put it down, you could go get another mortgage. Let's say you buy a $600,000 house, you get a $150,000 mortgage, you put that down. Yeah, okay, it might be cheaper to do it that way, and it might work. But again, I am not a person that loves the government getting involved in these type of things, because that's how they typically do stupid stuff and end up crashing the market. So I don't want them to get involved. I don't know that they're going to be able to figure this out. But it was interesting to think about could we do a portable mortgage? Could we do something where we could take our interest rates? And obviously they're also doing it because tons of people have low interest rates and they want to keep them. That's why they're doing it. So it'll be interesting to see if it actually becomes a possibility, because we would need more information to really break it down. Does it work? Could it work? Because there's going to be so many restrictions on it. So I think it's a fun idea. It's something that potentially could work, maybe, but we would need to see what would happen with that. So if you're thinking about moving, buying, selling, whatever it is, I'd love to talk with you. Again, guys, I work real estate through relationships, because for me, it's about what's best for you. I'm not here to sell you on anything. I'm here to make sure that I do what's best for you and work towards that. So if you want to go to coffee, I'd love to take you to coffee. My information's right here. I hope you'll reach out. Guys, you've been listening to Real Talk Real Estate. I'll catch you next time.